This topic is about financial intermediaries from learning module, market organization and structure. NYSE stock and LSE ADR represent the same underlying economic claim on the company. They should trade at equivalent prices. Pricing discrepancy plus simultaneously buy undervalued, sell overvalued are the definition of arbitrage. The goal is riskless profit from convergence, not risk reduction. That is hedging, or asset transformation. That is securitization. Large trades on normal public exchanges show the order to everyone. Other traders see the big order and can push the price the wrong way before the trade finishes. A special trading place called dark pool or similar hides the big order. No one sees it, so the price does not move much. These places show no client orders and have less strict rules than normal stock exchanges. This matches choice B exactly. Topic: Settlement and Custodial Services and Summary. Exchange-traded futures contracts are standardized. The exchange sets fixed rules for what asset or commodity, exact quantity, specific delivery dates, and other terms. Everyone uses the same contract terms. No private negotiation allowed. This makes the contract easy to trade and liquid. Choice A says terms are privately negotiated. This is not true for exchange-traded futures. This is the feature that is least likely. Actually never true. Topic: Positions and short positions. Recall, long put gains if stock falls, loses if rises. This is short exposure. Short call gains if stock falls or flat, loses if rises. This is short exposure. Combined long put plus short call equals synthetic short stock position. Payoff exercise price or strike price of the options minus current price of the underlying stock plus net premium equals short stock. Correct answer is B. For short sales, margin is based on the value of the shares sold short. Proceeds at current price. 50% means the investor must put up half the value of short position as equity. This margin protects the broker if the stock price rises and the short seller has to buy back at the higher price. Option A is correct. In short selling, the maximum gain is limited. Stock cannot fall below $0, so maximum profit equals initial sale price times numbers of shares. Here, 200 shares times $120 equals $24,000 maximum gain if price goes to zero. Loss has no upper limit because price can rise forever. This is the key risk of short positions. Potential loss is unlimited, while gain is limited. Margin protects the broker, but does not limit the investor's total possible loss. When you buy or long a stock, if the stock price goes up a lot, your gain can be very large. Theoretically, no upper limit. If the stock price goes down, the worst case is the stock price falls to zero. You lose only the amount you paid, your investment. So gains are unlimited. Losses are limited to what you invested. Option B is correct. Topic: leveraged positions. Initial margin 60% means the investor must put up 60% of the purchase value with their own money. Maximum leverage equals total position value divided by investor's own equity. Total position value is 1. Investor's own equity is the initial margin requirement. So, maximum leverage equals 1 divided by initial margin requirement equals 1 divided by 60% equals 1.67. Leverage multiplies the percentage return on the stock move. Stock rose 20%, but with 2.0 leverage, the investor's own money earned 40%. Ignoring interest and cost keeps the calculation simple and shows pure leverage effect. Return is always on the investor's equity only, not the total position value. Return is calculated on initial equity only, $10,000, not total position value. Dividends increase return received by long holder. Interest and commissions reduce return. Costs of leveraged position. Margin amplifies returns. 10% stock gain becomes around 19% equity return due to 2-to-1 leverage. Borrowed amount stays fixed. Only market value and equity change with price. Margin call occurs when equity as a percentage of current market value hits the maintenance requirement. Initial margin was $28,800 divided by 48,000 equals 60%. But margin call depends on the lower maintenance requirement, which is 25%. Remember, return is on the investor's total cash put in. You have to include purchase commission on initial equity, not just equity. Interest reduces profit. Dividend increases profit. Commissions reduce profit on both buy and sell. Leverage makes the percentage higher than the stock gain. 3 divided by 45 is almost equal to 6.7% stock gain, becomes around 16% on equity. Margin call uses only the maintenance margin, 25%, not the initial margin, 60%. The call price is always lower than the purchase price when margin is used. The formula protects the broker by keeping equity at least 25% of current value. Loan amount stays fixed. Falling price reduces equity until it hits the limit. Return is on total cash the investor put in at start. Equity plus purchase commission. Commissions reduce profit on both buy and sell. Borrowing costs money. Interest reduces the gain. Leverage increases the return on your own money only after subtracting the interest cost. No dividends or commissions means the calculation is clean and direct. Margin call uses the maintenance margin, 25%, not the initial margin, 40%. The call price is higher than half the purchase price because the initial equity was only 40%. Loan stays fixed. Falling price reduces equity percentage until it hits 25%. Borrowing money lets you control more stock than your own cash alone. Here, you control $50,000 with only $20,000. A 20% gain on the full amount becomes 50% gain on your own money. Leverage multiplies both gains and losses. Remember, margin call uses only the maintenance margin, 30%, not the initial margin, 60%. The call price is always lower than the purchase price when margin is used. Topic: Validity instructions and clearing instructions. Good for the day means the order is valid only during today's trading session. This controls how long the order stays active. This is a validity instruction. It decides the time validity of the order. Execution instruction is how to fill the order, such as market order or limit order. Clearing instruction is how to settle the trade after it's done. Who delivers shares? Who pays money? Immediate or cancel means fill as much as possible right now at the limit price or better. Any unfilled shares are cancelled instantly. For a limit sell order, only buy orders at or above the limit price can match. Here, all buy orders are below $40.50. Nothing fills. All 800 shares cancelled. Stop orders, option A and C, trigger a sale when price reaches a level, but they do not guarantee the fill price, especially in volatile or gapping markets. A put option is the only strategy that legally binds someone to buy from her at $130. The put writer must buy if she exercises. This is the classic use of a protective put. It acts like an insurance against a big drop while keeping upside potential, minus the cost of the put.